Lori, good to have you back on. What is your projection for 2022?
Well, thanks for having me on, Brian. It's always fun to be here. And look, it's forecast season, and we've come out with a number that is not quite exactly in line with the others, but pretty close with a few of them. 50-50 is our number for next year. And, we sort of look at a few different models and back tests. I would say a lot of our economic models are actually saying the upside could be a little bit more, a little north of 5,100. Our valuation-based models, most of which look at stocks versus bonds, are pointing us more to 50-50. So we started out with a little bit of conservatism to the year. But look, we think it's going to be a good year next year. We think it's going to be a little bit more difficult, a little bit more challenging than what we've seen this year. We won't necessarily go up in a straight line. We are going to be very balanced in terms of positioning trades. We expect some zigs and zags there, but overall, we think it's going to be another good year for stocks.
That's a pretty good target, 50-50. I mean, you think about it, what is that, about 8, my math, 8%, 8.5% return, plus throw in a little dividend yield? You could get to 10%.
You could. And look, I think targets are rough estimates, right? Is how we see the world unfolding now. That's why, strategists are always making revisions, making tweaks as the year progresses. But I will say, you mentioned dividend yields, and one of our tests that looks at stocks versus bonds, we actually look at the dividend yields of the S&P 500 companies and the percent of companies that have a yield in excess of the 10-year Treasury. And that's been in the 40 to 50% range. That's been actually, strangely, a very good indicator on a 12-month forward basis of how well stocks are going to do in the year ahead. And that model's pointing us to about an 8% return. We think it speaks to the appetite of retail investors, and we also think it speaks to the fact, that while many asset classes are overvalued at this point in time, stocks are still the best game in town.
And when we look at stocks, I know the Russell 2000's it's on a 4-day losing, oh my gosh, 4-day losing streak, right? But it hasn't gone down much. It's had a nice run. Looking at your research, Lori, it looks like you are more optimistic on the smaller caps than the larger caps. Is that true? And if so, why?
It depends on your time frame, but I would say we think the next big leg up in the market is for small caps and value to outperform. We've called it value's last hurrah, small caps last hurrah. We think those kind of deeper, undervalued cyclicals will do well through the middle of next year, ahead of Fed rate hikes and ahead of markets starting to anticipate a slower economic recovery in 2023. But next year, the consensus data is still calling for a 4% GDP year. That's typically when we see small caps outperform. That's typically when we see value outperform, when GDP is tracking above GDP. And when we're going into Fed rate hikes, usually small caps don't start underperforming until well after the rate hikes begin. So we think we've got some room for those trades. And look, I'll say just on the recent price action, last week we were talking about how small caps had just made this sudden breakout, had been hitting new year-to-date highs. I think that's because investors were really queuing off the broader economic mosaic and the inflation data. Small caps tend to do well when inflation expectations are rising. But I have heard over the last 4 or 5 days a lot more focus on the COVID flare-up, which I think caught investors off guard. And I think that's probably depressed small caps a little bit in the short term here.
Yeah, and I know that, again, not to be a broken record on the positive side here, but hospitalizations in the U.S. are down 52% in the last couple of months, actually. So we get focused on cases, maybe focus more on alcohol. Anyway, nobody cares what I think about that. It's just data anyway. Is there any part of the market that you dislike, Lori, that you actually just say, putrid, stay away from it, it stinks?
I wouldn't say putrid, but, one area that's been coming up in conversation the past few days, as we talked about, we're in outlook season. REITs are an area that we're underweight, the real estate sector, and it's been an inflation hedge. Investors have made some nice money in that space this year, but it looks wildly overvalued to us at this point in time. So we think there are better ways that you can play inflationary pressure, small caps being one of them. I would say another underweight we have is communication services, which has the internet names, media, some telecom in there. And, we haven't had a great read on that space from our internet analysts at RBC and some of the survey work we've done with our analysts. He's been a little bit cooler. And also we see policy risk. We don't see particularly compelling valuations. Now, we have told investors to say balance between value and growth over the next year, but we do it in tech, not comp.